So we're here at the ESCoE Annual Economic Measurement Conference 2023, and I'm joined by David Miles, who's just given us our first keynote presentation on the topic of house prices, the power of interest rates, demographics, and work from home. So David, it was a fantastic keynote. Could you start by just giving us a brief little summary of your work and your paper, and please introduce yourself as well?
I'm David Miles, Professor of Economics at Imperial College, and also I have a role at the Office for Budget Responsibility here in London. And I was trying to do two things in the talk, one of which was to look back over the last 40 years at what's happened to housing in the UK, and particularly house prices, and put it in the context of what has happened in other countries and how we're different, and the UK is different. And then also speculate about whether the next 30 or 40 years might be different from the last 30 or 40 years. And on average, looking back, going back to the early 1980s, since then house prices have risen greatly in the UK. They've risen far faster than consumer prices and the prices of other things people consume, so much so that if you look at the 7 big rich economies in the world, the G7, the rise in house prices relative to consumer prices in the UK is far greater than in those other countries. In the UK, house prices have risen about 3.5 times as much as the price of consumer goods in general. And they've also risen relative to people's incomes so that they're more than double now as expensive relative to what people earn, their disposable earnings, as they were in the early 1980s. And part of what I spoke about this morning was some analysis of the key driver, particularly of the increase in house prices relative to people's earnings, which after all is the thing that people feel most acutely and makes it much more difficult now for people to enter the housing market than it was 20, 30, 40 years ago. And there I think probably the key factor has been what is an extraordinary decline in real interest rates in the UK. And we have a nice measure of real interest rates, which is that the UK government for almost the whole of this period since the early 1980s has been issuing government bonds which are inflation proof. In other words, they give you a guaranteed real rate of interest adjusting for whatever happens to consumer price inflation. And the interest rate on those things has come down very dramatically from about plus 4% in the early 1980s to 3% or so during the 1990s, and then about 2% by the end of the 1990s, down to close to zero at the time of the global financial crisis, and then into negative territory. And so until very recently, the real interest rate, which used to be plus 4%, had fallen to about -2%, -2.5% in the UK. And our analysis suggests that it's really that factor more than any other individual factor which has been responsible for such an enormous increase in house prices, particularly relative to people's incomes. It's not the only factor at work, but it accounts for, we think, something like all the extra increase in house prices over and above what's happened to average disposable incomes in the UK. So without that huge decline in real interest rates, houses might now be no more expensive relative to average earnings than they were in the early 1980s. So it's an extremely powerful effect. And in a way, it's not too difficult to think about why this has been so powerful. Houses are long-lived assets, and one can think about valuing a house in much the same way as one could value, for example, a share in a company, an equity, where we think that the way to assess its true fundamental value is to take the stream of earnings that you get from owning a share in a company and discount it back at some required rate of return, some real rate of return to discount the future earnings. And one can play the same game, if you will, with houses and think about the future real value of the services they provide. If it's a rental accommodation, that is the rent. If it's an owner-occupied property, it's what you would have to pay in rent to enjoy the services of living in that property. So take the flow of future rents, discount it back using a real rate of return, a discount factor. And when that discount factor changes by as much as it probably has because real interest rates come down, they're not surprising you get a much bigger value. That's the backward-looking part of what we spoke about. And then I speculated a little bit about whether and how things might be different in the next 40 years than they've been in the last 40 years, and argued that that big driver of the increase in house prices, very substantial falls in real interest rates, which has already turned around just in the last year or so, is not likely to carry on falling in the same way as it did over the last 40 years, over the next 40. That's one factor. There are demographic factors. There are more recent developments in the ability to people to work from home, which I think gives people more flexibility to live in different places and potentially much cheaper places than they in the past have had to live, because one needed to be relatively close to where one's work was. So in the forward-looking part of what I spoke about, I've presented some arguments as to why it was highly likely that the next 40 years would not look like the past 40 years.
So we'll come back to the forward-looking part in a moment, but I just want to head back to the beginning of your talk and what started all of this interest and how you started your presentation earlier on, which was this very dramatic increase in UK house prices relative to consumer prices, real house prices. You said it was about 3.5 times since the 1980s. Something I found particularly striking about that chart was how the UK house price pattern seemed more cyclical than in other countries. So where in other countries there had been a relatively smooth increase, in the UK it seemed to go up more in periods and then back down. Is there anything unusual about the UK housing market that would give it that sort of pattern?
I think you're right. It has been more volatile, more cyclical, and I think more closely tied to fluctuations in short-term interest rates, the kind of interest rates set by the Bank of England. And there's a good reason why they have a stronger impact both in driving house prices up and helping drive them back down again than in most other countries. And it is because of the nature of the mortgage market in the UK, where for most of the last 40 years, and it's still true to a very large extent, mortgages typically are variable interest rate mortgages. When the Bank of England moves rates, the majority of mortgages reprice in a relatively short period of time. That was particularly true in the 80s and 90s and into the early part of this century. Nowadays, in recent years, people tend to favor mortgages where the interest rate might be fixed for 2 years or 3 years, but still relative to many other countries, relative to Germany, relative to the US, where it's much more usual for people to fix the mortgage rate at the point at which they take a mortgage out. And in the US, to fix the mortgage rate for maybe 25 or 30 years. In Germany, maybe a little bit shorter, but still 10 years or so, which insulates the housing market much more from changes in interest rates set by central banks than is the case in the UK. And I think that does generate more cyclical volatility here.
And why is the UK so different in that respect, do you think?
Well, it's a good question. I mean, in some ways, we are very slowly looking a bit more like Germany. We're still a long way from the US, where the 25-year fixed rate mortgage is still the most common product. But people now probably the single most common type of mortgage taken out by new borrowers in the UK is probably the 5-year fixed rate mortgage, which in the 1980s was hardly anybody had a 5-year fixed rate mortgage. Now more people do. It's partly because perhaps with house prices having gone up so much, with people having to borrow a lot relative to their income, the risk of big changes in the interest rate on the mortgage in a short period of time is exacerbated, and that increases the attractiveness of the certainty of fixing the mortgage rate. But still, we are still internationally a country where the effect of central bank changes in interest rates in the housing market, I think, comes through quicker and is more powerful.
Very interesting. So your work in your presentation and the chart we were just talking about with the rapid rise in real UK house prices was all, as I understood it, in the aggregate, UK as a whole.
Yeah.
And we know there are very different dynamics in house prices across different regions of the UK and
Yes.
constituent countries of the UK.
Yes.
Most notably the difference between London and everywhere else.
Right.
Could you say something about those regional patterns and the extent to which your work and your models of the driver of those house prices speak to that, or not?
Yes, I mean, you're right that the analysis, much of the analysis I was talking about was a sort of aggregate UK picture. And underlying that, you're absolutely right, is a lot of regional variation. I mean, huge, in fact. I think why that's come about and why it's probably more extreme, that variability across the country, than it was 40 years ago, is to do more generally with the pattern of employment and relative incomes in the UK over that period. Obviously, if you go back to the beginning of the 1980s, you've still got a country with a lot of heavy industry and a lot of jobs right around the country. There's been a process of deindustrialization, probably at its strongest in the 1980s, which has moved the centre of employment even further to the southeast of England. We're now a overwhelmingly service sector economy. The manufacturing sector is barely 10% of GDP in the UK. That has generated, for much of the 1980s and 1990s, a greater variability in unemployment regionally. And I think some parts of the country really still haven't yet recovered in terms of jobs and average incomes, and to some extent levels of employment, from that deindustrialization in the 1980s. So I think you've got that going on. I think there's also, to some extent, a bit of internal dynamic to the process, that if you have parts of the country that are attracting more people there, where incomes tend to be a little bit higher, and you're leaving other parts of the country, naturally enough, house prices will rise in the one part relative to the other. And if people then extrapolate from that and think that actually if you buy a property, even though it's expensive and it's difficult to buy for the first time in some parts of the country, prices will then go up faster there and you'll get your money back. And that might not happen in other parts of the country. And there's a kind of self-reinforcing then part to that mechanism. And I think that's been at work also over this period. And where it's taken us to is a position with really huge variability in the price of houses that otherwise look, relatively similar.
Now, you talked there already about some of the drivers in the increase in house prices that you identified in your work, the decline in real interest rates, increases in aggregate income, expectations of future house price growth and therefore holding gains and so forth. I wondered if there was another set of drivers or explanatory factors to do with more social factors, such as changes in social attitudes towards housing, changes in family dynamics. I think it's sometimes said that the UK is a country of homeowners, or we put a particular status on home ownership that perhaps other countries don't. So to what extent do you think that's important in driving demand and therefore prices for houses, and has that changed over time?
I think those things are important, but I also think they've changed quite substantially. And in fact, some of those historically strong characteristics of the UK, very great desire of people to own homes, people buying homes quite early in their lives relative to in other countries, a relatively smaller rental sector than in some other countries, particularly in continental Europe. Those things have actually changed, I think, in recent decades. Partly as a result of house prices becoming so much more expensive. It's much more difficult for people to buy houses in their 20s now than it was in the 1980s. And I think that has, in some ways, it's kind of forced an adjustment. Certainly it's true that if you just look at the statistics, the owner-occupation rate in the UK no longer stands out as being unusually high amongst comparable countries. I mean, it's not the case anymore that the UK owner-occupation rate is, well over 70%, and the average across the rest of Europe is low 60s. Now the UK owner-occupation rate is substantially lower than that. I think we're around about the mid-60s now. We don't look unusual in Europe. It's Germany that looks unusual, with having a much lower owner-occupation rate. And there are many countries in Europe now with a higher owner-occupation rate than the UK. Partly that's to do with financial liberalisation in other European countries, which allows people to borrow money. Ours came in the UK, financial liberalisation, really in the mid-1980s, and it was largely done by the end of the 80s. In other countries, it's happened much more recently. So actually, some of those things that used to be true in the UK, I think are no longer true. And possibly because young people find it so much more difficult to get into the housing market, can't do it until their mid or even late 30s. It's had an effect that it's no longer a realistic aspiration to be a homeowner at age 25 for most people. And I think that then makes young people feel actually it's not the be all and the end all. And we have a reasonably big rental sector now in the UK. I mean, it's the flip side, of course, having an owner occupation rate in the mid 60s rather than well into the 70s. Rental market's got bigger. People have got used to being in the rental sector for longer. And perhaps also a realization that that's not a sign of, failure. Certainly in Germany, people don't think that being in the rental sector until people are in their 40s sometimes is a sign of economic failure. And maybe the UK has become a bit more like the continent of Europe in that sense.
So just as attitudes are affecting house prices, so house prices are affecting attitudes?
Yes, I think there's definitely a sort of two-way play between those things.
So the other option to owning a house is, of course, renting it. And as you said, that's rental rates have gone up. More people are renting.
Yeah.
But what has happened to rental prices, especially in real terms? You've described a big increase in real house prices, but what about real rent?
Well, I think if you look at the whole 40-odd year period that I spent much of my time thinking about, the big picture story is that for that period as a whole, generally house prices have gone up faster than rents. And so the rental yield, just the ratio between the rent on a property and its market value, has tended on average to come down. It's somewhat volatile. And in a way that's not entirely surprising, because if you think of the rental yield to a landlord, the investor in the property, well, what it is it's the rate of return. I mean, it's not all of the rate of return, because you've also got potential capital gain on the house, but it's a large part, the largest part of the yield on that investment in a rental property. And as real interest rates have followed this downward trajectory, the required rate of return in terms of rental yields has tended to come down with it, which is perfectly natural. After all, in a world in which you can earn plus 4% real on a very safe asset like an index-linked bond, the requirement in terms of the rental yield will be higher, one would expect, than in a world in which the real interest rate on an index-linked government bond is -1 or -2%. And that seems to be naturally why rents don't go up as much as house prices, and the rental yield has tended to come down. Now that's gone slightly into reverse just in the last year or so, as real interest rates have turned a corner and started going up. They're still quite low, but they've started to go up. And I think it's also coincided with some policy changes, tax changes in particular, that have made being a landlord somewhat less attractive. And I think that force is at play right now in the UK, and has meant that demand and supply conditions in the rental market have become very tight for those looking for rental property.
So you told us about how we can understand and explain the increase in real house prices over the past 40 years, and the second half of your talk was about what happens in the next 40 years.
Yeah.
You talked about demographics, work from home, and the future trend of real interest rates.
Yeah.
So tell us a bit more about those factors and how you think they'll play into house prices.
Okay. Well, let me start with real interest rates, which has been the big story, I think, about why house prices went up faster than people's incomes over the past 3 or 4 decades. I think we're probably in a quite different world now. And the next 40 years, I don't think will look like the last 40. Remember, in the last 40 years, real interest rates just fell and fell and fell and fell on index-linked bonds. If that happens for the next 40 years, people will be accepting a real rate of return of minus 6%, lose 6% a year by investing in government bonds. Guaranteed that's what you're going to lose that money. And that seems wildly implausible. I think, if anything, a mild increase from levels we've got to now, which is already underway, seems more likely for the next 40 years. A number of factors at work there. One is that some of the biggest investors in UK index-linked, inflation-proof government bonds are going to become smaller players. I'm talking about defined benefit pension schemes, which are being wound down gradually in the UK, and I think that will be inexorable, and it will continue over the next few decades. They've been a very big buyer of UK index-linked government bonds. They're probably going to be net sellers over the next few decades, as opposed to massive buyers over the last several decades. That will make a difference. The last several decades have also seen China's emergence as being well integrated into global capital markets, and it's a country that has had an extraordinarily high savings rate. That has fueled the demand for assets like government bonds, and it's allowed many governments around the world to finance fiscal deficits at very favorable rates, as there's been a very strong demand for those investments from parts of the world that until relatively recently weren't integrated in the world capital markets. But that process has now run its course. It's quite likely that the savings rate in China will be lower in the future than it has been in the past. And we've gone through the transition where that drove interest rates down. And so that's another force that has kept real interest rates low and falling, which, if anything, will go into reverse in the future. So I think there's some strong arguments why the real interest rate path will not be downwards for the next 40 years. It's flat and possibly even rising slightly. On demographics, it's pretty likely that the growth of the population in the UK will be very much lower over the next 30, 40 years than it has been in the past 30, 40 years. That's not unique to the UK. In fact, there's many European countries where it looks like population will fall very markedly. That seems quite likely, for example, in Italy, and to a lesser extent perhaps in France and Germany, but declining populations there are what the United Nations predict is going to happen in those countries as well. There are some countries in the world where it seems to be likely to be a very sharp fall in population. China is one in terms of absolute numbers, but relative to its current population, a country that really stands out is South Korea, where the fertility rate, the average number of children born to women during their life, is not much above 1. And that's, if you carry on like that, your population is almost certainly going to fall. So interest rates probably not going to be falling. Population in the UK may be flat, possibly declining a little bit, but not rising as much as it has over the last 40 years. And then a very new phenomena, which is the increasing ability of many people to work from home, which changes, in an obvious way, the ability to live further away from your place of work. And it's if you only go into the place of work 2 or 3 days a week, then obviously one can live further away and decide to do a long commute, but only on 2 or 3 days a week as opposed to 5. And that opens up the possibility of moving further away from the urban centres where most jobs are to places that are more affordable, can mean you have more space and a bigger house. Now that won't affect the population in a uniform way at all. In fact, it looks quite likely that the ability to work from home on average is greater for people who have higher incomes. And if you think of some of the lower paid jobs in cleaning, in nursing, maybe in teaching, in the police and the fire service, those people have virtually no ability to work from home. And it tends to be higher paid jobs that people can work from home. So there's a distributional impact on that. But I think the net effect of it all is that if, as seems plausible, there has been, as a result of COVID and what we discovered about the ability of people to work from home, a kind of step change which will be permanent in the flexibility about working from home for many people, That tends to reduce demand in some of the most expensive parts of the country, close to the urban centres in cities where many jobs are. Allows people to move to slightly cheaper areas. That, of course, reduces the prices in those very expensive areas, which actually is to the benefit of those who themselves might still have to go into work 5 days a week. So some analysis that I've done with one of my colleagues at Imperial College, James Sefton, tries to work out, well, how big are these effects? And in terms of what it might do to the average level of house prices, we think it's a fairly big deal. I mean, it could be worth, some of our results suggest, 10, 15% of house prices is not all going to come through in the very short term, because people take time to adjust to the ability to work from home. But there it is. So I think you've got three forces. Interest rates won't do what they've done in the last 40 years, probably. Population is not going to grow as much, might even fall in the UK. Work from home is probably a helpful development in making housing more affordable generally. And those three things go in the same direction, and therefore a replay in the UK of the last 40 years in terms of how high house prices have risen is probably not on the cards for the next 40 years, which actually is a good thing.
So perhaps we'll come back in 40 years' time and check in with you on that.
If I'm still here, I'll tell you whether that turned out to be right. I hope it is right.
So we're, of course, here at a measurement conference. So I wanted to ask you about data. Did you get all the data that you needed for this work? Was there any data that you didn't have that you wish you did? Say something about that. I
mean, generally the UK is pretty good on housing market data. We've got data that goes back quite a long way. I think both the official national statistics data on house prices and also some of the data put out by the Halifax and the Nationwide is very carefully put together, and it does a nice adjustment for the inevitable month-to-month variation in the type of houses that are sold, and it adjusts for the mix of houses, looks a bit different. So I think you can rely with quite a high degree of confidence on the evolution of house prices in the UK. We're pretty good at measuring that. And then you've got, more recently in the last 10 years or so, this tremendously rich data that's available from companies, private companies like Zoopla, which allow you to sort of track transactions, almost as they happen right across the UK by postcode, and also gives you pretty good data on rents, which in the past have been quite more challenging to measure across the UK. And I think some of those newer data sets are pretty good on that. So I would say that when it comes to housing and house prices and transactions, and on the mortgage side as well, we're pretty well served in the UK on the statistics front.
Brilliant. Thanks very much, David. That's been fascinating. Where can people go to find out more about your work?
Well, there's a few papers that describe some of the things we've just been talking about. They're all on my website, which is at Imperial College, pretty easy to find, and there's quite a few papers there.
And have you got anything else planned in this sort of space?
Well, I think the work from home stuff is really interesting because it has the potential to have a big impact on people's lives, their livelihoods, welfare, and knock-on impacts on the housing market. And that's an area where I think quite a lot of economists across the world are doing research. And it's somewhat embryonic because really the big shock to the ability to work from home, and I think it was a shock, came with COVID, which is still with us to some extent, but it's a couple of years ago. And the effects of that will take time to play out because companies take time to work out what kind of long-term employment contracts are we now offering people. Do we want people in the office 2, 3, 4, 5 days a week? An individual's adjustment to that, which could well involve moving to a different kind of house in a different part of the country, that obviously takes time to play out as well. So I think we're only just beginning to have a feel for how significant this is. And it's a subject where I'm doing some work with colleagues at Imperial, and I think many others work in the area as well.
Thank you very much.